Welcome to the latest live stream here on March 7th, 2025. So the title for this one is Borrow from Yourself Without Risking Your Financial Future. What on earth does that mean? So before I dive into that, I want to share my screen and just make something very clear. And that is this. So you've heard me talk before about these participating whole life insurance contracts that we use for infinite banking concepts. And the loan provision is often something that people get very focused on, and rightfully so. It's a brilliant piece of the puzzle on what all the attributes that these contracts have. I just want to before I dive into that, these are the 8 different attributes that these whole life insurance contracts really have. And the flexible loan provision is just one. So I just wanted to touch on that and make you all aware of that it's an important piece of the puzzle, but it's just one piece of the puzzle. I think there's a lot of over focus on it sometimes out there in the TikTok world and people talking about it. Because you have the constant compounding, the liquidity that you're developing and building over time is hugely important, not just for rainy day fund, but also for opportunities as they arise. And then, of course, the privacy. These are private contracts between yourself, your family, and whoever the insured or whoever the owner is, and the life insurance company. So they're extraordinarily private, which is important to me, I think to a lot of people, unlike bank accounts, retirement accounts, that kind of thing, which are very much, people can see what's inside of them. Income tax-free transfer of wealth. Obviously, that's the death benefit. That's the thing that most people associate with life insurance. That's a big chunk of money is going to go out to your beneficiaries at some point, and maybe not impact you directly so much, but certainly help take care of your family. And then competitive yield, that's the 4.5% that's guaranteed, growing inside of the cash value. That's a hugely important thing because that's net of taxes. It's really important to keep that in mind. And then monthly cash flow growth, cash value growth, and then the constant compounding, which is over time, the internal growth inside of these contracts is pretty extraordinary. It takes a while, but over time, the internal return is really impressive. And again, it's all net of taxes, which leads us to the policy loan provision, which I'm going to talk about more. So I'll stop. Let me go back to just me here. So I'm going to touch on a couple of different things here. For infinite banking and there are sort of optimal ways to utilize these loans and less optimal ways to utilize them. So I want to just kind of touch on how they work. So you start a policy, you have a certain amount of cash value available, whatever that number happens to be, and 95% or thereabouts of whatever is in the cash value you can access via policy loans, or you can actually pull it right out of there. You don't want to pull it right out of there because then you're actually pulling out your principal. When you borrow against it, you're not impacting the cash value because it doesn't actually come out of there. You're taking a loan from the life insurance company based on what's in your cash value, which gives you the ability to cycle it back in and pay it back however you see fit. Thus, the unstructured loan is completely up to you how you do it. And as the late great Nelson Nash taught, it's best if you just treat it, be disciplined about it, and treat it like you're the bank now. You're the banker. You've taken a loan out based on your cash value to do whatever you want with it. I was talking with someone earlier today about how they're going to incorporate probably buying back a car loan. They have a new car that they're spending about almost like $1,100 a month on at 6%. And it's well within their means to afford it, but I'm going to show them how we set up a policy, and it won't necessarily have to be a huge one, and actually not just pay off that car loan, but actually now assume the role of lender. So that $1,100 that's going away from them, never to be seen, will now come back into their own system to be used for whatever else they need the next time around. So that's the sort of the safe and the best way to utilize policy loans is to keep it simple, and you're just assuming the role of the lender for whatever it happens to be that you're using the loan for. Now, you don't have to do that. There are people who do not pay the loans back at all. They don't. They just charge a simple interest rate, and even the interest rate you don't have to pay back. So it works best if you just, as best you can, take loans out and pay them back to the life insurance company, because then it's like putting money back up on the shelf to use for whatever else you need to use it for. So let me I'll go on to the next one. I mentioned before, accessing your cash values, you don't want to pull it out of there because you dip into the principal. And that is one of the most powerful things about these, because you don't, by borrowing against what's in the cash value or your principal, you're not touching it. It's still growing at that guaranteed 4.5%. And as long as you replenish it and you keep paying your premiums and you're making deposits back into your system, then you can keep using it ongoingly for whatever comes up, whether it's other debts or whether it's vehicle purchases, or this person I spoke to earlier, they like to get into real estate investing. So the idea is to fund a policy, get as much cash as you can in there, and then when a real estate deal comes up and they're ready to put a down payment on a rental property, they can do it, but it comes out of their system. They take a loan out from the life insurance company based on what's in the cash value, put the down payment on the property, and now you've used one asset to create another asset. So now you have these two things growing concurrently. So it's another huge, important piece of the puzzle. One thing that people can get themselves in trouble with is sometimes you'll hear people talking about like a 10%, 1090 or 2080 premium based to paid up additions. What that means is that higher number, that 80 or 90% of premium that goes into the cash value and becomes available capital. And just, it's okay to do that. You can impact the long-term growth of these things by skewing it so much on cash value. And you can get in trouble if you take out loans. Say if you pay let's say it's a big policy, $100,000, and 10 of it is what's called base premium. 90,000 is paid up additions, go right into the cash value. And let's say they take a loan out for $85,000 for whatever, say a rental property or something. And you can get in trouble if you're not on top of it. If you don't pay the loan back and you let the policy lapse, that becomes a taxable event because you haven't put enough principal or premium in to the policy if you let it lapse. So that's one thing that people get in trouble with sometimes. They'll just kind of lose sight of that first rule, whereas you're now acting as the lender. So you need to be a responsible lender. It doesn't benefit anybody more than you. Nelson Nash called it, it's like stealing the peas. If you take out loans and never pay them back, it's like you're a grocery store owner. And if you just keep hitting as your family, say your family owns a grocery store, and you figure, well, I can just, take food out of the freezer and not pay for it. That's called stealing the peas. It'll seem great because you're getting free food, but you're not. You're actually adversely impacting the business, and very likely that's going to ruin it. It's almost like killing the goose. So you don't want to do that. So that's one way people get in trouble, is they set those up when there's too much cash, they pull it out, and they don't manage, and they let it lapse, and then it becomes a taxable event because not enough premium has gone into it to support that when you have outstanding loans and the policy lapses. So that's one of the biggest issues that I've seen people get into. Now, infinite banking versus traditional loans, I mean, it's pretty obvious. I mean, if you can utilize the bank's money, I'm all for it. No question about it. I'm not a fan of the banks. Nothing wrong with the people who work in them, but just as institutions, I don't like how they set themselves up to just succeed and just run the world pretty much. And I think it's grossly unfair, if nothing else. So, and as anyone knows, if you try to get a loan from the bank, there's lots of requirements that they have you go through, lots of paperwork, lots of digging and prying, and then you have to provide collateral, all kinds of things like that. So if you can set up your own system with these infinite banking whole life policies, you completely control how the loans go, how much you want to borrow, what it's for. The life insurance company never asks you what it's for. When I take out loans, I just call them and I say, look, we're going on, and say, look, I take out, say, a $10,000 loan for something that I need. It just gets transferred to my bank account, within a few days. No questions asked. They don't put me on any kind of payment plan. It just starts to accrue simple interest, which a bank will never do. Obviously, you take a loan from the bank and they get you on an amortization schedule like that. You miss payments, there's fees. If you're late, there's fees, and you can actually lose whatever it is, the collateral. Say it's a car or something. They can take it back if you are delinquent on your payments. That's not the case with these policies. So they are the ultimate in control. So you get to say how it goes. And as I've said before in some other videos too, that even the simple interest that the companies charge, you don't have to pay that back. They don't force you to pay that back. It works best. It's kind of along the same lines as not stealing the peas. If you have outstanding loans, I was taught, and I do it myself, and I teach this to my clients, that if you have outstanding loan balance and interest has accrued, you'll get a notice from the company, the life insurance company, when your next premium is due, and saying, look, you owe your, say it's $10,000 a year premium, and you have outstanding loan balance, and you owe, say, $1,000 interest on that loan. You want to pay that too, because it just gets reapplied to your cash value, so you don't actually lose it. So think about that. You're being charged in a simple interest rate, but as long as you pay that back, that portion, it just gets reapplied to your cash value. I don't know of any other type of lending institutions that do that. Usually when they charge interest, you lose it, you never see it again. So it's just another piece of the puzzle. And you can get super fancy. You can, if you take out loans, you can just set up an automatic monthly payment back to the life insurance company, which every payment that goes in, it gets reapplied, and you start to refill your coffers inside your cash value. So, and then people sometimes they'll pay back a lump sum. They'll just, I've done both actually, and I've done, I have outstanding loans too. I'm not that worried about it because we're still building our policies out. But as I pay the premiums and I keep paying the interest that are charged on the outstanding loans, because I know I'm not losing it. It just goes back and it gets reapplied to my cash value. So these are just, some of the, I will touch on one other thing before I sign off. There can be overborrowing. A good rule of thumb is to maybe quarterly, or if it's for larger purchases, or if you're going after debt, taking loans out. But there are times when it doesn't make sense to do so. I've had plenty of clients who have started a policy and they had no debt, and there was nothing really to put that money to work with. I mean, if there's some place to put it to work with, you want to do that, because money sitting idly it's better to put it to work and then flow it back into your system. And you don't have to do it that way. I've had a client start a policy of $50,000 a year, didn't do anything for the first year and a half, and then eventually he was able to use about $100,000 of cash value to help him fund a business endeavor. The banks told him that they weren't going to lend him anymore, and he needed $100,000 to close the deal. So he called me and he said, "Hey, what should I do? I have a $50,000 premium due, and I also have to come up with $100,000 to close the deal on the business." I said, "Pay the premium, have them expedite it," and within, I think, 4 to 5 days, he had $100,000 in his account, no questions asked, from the life insurance company, closed the deal on the business, boom. And then again, because he didn't tap into the principal, he has the ability to cycle it back in and pay that loan back for the next thing he's going to need it for. So it really is a beautiful thing. So again, the unstructured policy loan provision is hugely important. It's only one of 8 things. It's really important. All these different attributes of these contracts is really what make them so the perfect asset, which is what I like to call them. So, okay, thank you, and good to see you again. Until next time, be well.